picture this. It's a random Tuesday night. You open your brokerage app for no reason, just out of habit, and there it is. A number that looks like an invoice you didn't know you owed. Your $500,000 is now $350,000. Not because you spent it, not because you did anything reckless today, just because the market decided to offer you a different price. And in that moment, the terrifying question isn't, will it come back? The terrifying question is, do you have a plan that lets you wait for it to come back? Or will you be forced to lock in the damage? Because here's the uncomfortable truth most people never hear until it's too late. $500,000 isn't a lot if your plan requires perfect behavior. If your strategy only works when you feel calm, when headlines are quiet, and when you never make a human decision under stress, then you don't have an investing plan. You have a fragile story. And Benjamin Graham, more than anyone, built his entire philosophy to protect ordinary people from exactly this moment. Not by predicting the future, not by finding the next hot stock, but by building a portfolio and a mindset that can survive the one thing the market always does. Eventually, it tests you. So in this video, we're going to do something practical. We're going to identify the single mistake that makes $500,000 feel small, even though it sounds huge. And then we're going to build a simple defensive blueprint, Graham style, that makes you harder to break in a market that's loud, emotional, and obsessed with hype. Because the goal isn't to beat the market this year. The goal is to never be forced into the kind of decision that turns a temporary drop into permanent loss. Let's start with the mistake. The mistake is not that you own stocks. The mistake is designing your entire financial life around the assumption that stocks will behave nicely on your timeline. It's building a plan where your money is technically invested, but psychologically and practically, it's sitting on a hair trigger because the first major drawdown will force you to sell, not because you're weak, because your plan has no margin of safety. Graham had a phrase that should be tattooed on every retirement statement: margin of safety. Most people think it's only about buying a stock below intrinsic value. And yes, that's part of it. But for the ordinary investor, margin of safety is bigger than stock selection. It's about designing your whole approach so you can survive bad markets without destroying yourself. Because the market doesn't just drop. It drops at the worst possible time. When you're scared, when you feel behind, when you're thinking about retirement, when inflation is in the news, when interest rates are climbing, when layoffs are trending, when every headline is screaming recession and the algorithms are feeding you panic, that's when people do the most expensive thing in personal finance. They convert volatility into permanent damage. Benjamin Graham had a character for this. He called him Mr. Market. Mr. Market shows up every day and offers you a price. He's manic. One day he's euphoric and wants to pay you too much. Another day he's depressed and wants you to sell to him for almost nothing. Graham's entire point was that Mr. Market is there to serve you, not to instruct you. But here's the catch. Mr. Market only serves you if you're not forced to accept his worst offer. And that is why $500,000 can be not a lot. Because if your plan requires you to sell when Mr. Market is depressed, your portfolio stops being a long-term investment and turns into a short-term hostage situation. Now let's make this real, not theoretical, real. Imagine two ordinary people, same age, same income, same goal, a safe retirement, same starting portfolio, $500,000. Person A is what the internet quietly pushes you to become. They're heavily invested in whatever has been working recently. Growth, big tech, hot themes, maybe a little AI exposure because everyone says that's the future. Maybe a handful of story stocks, maybe a crypto flyer. Their allocation is aggressive, not because they planned it that way, but because the market ran up and they never rebalanced. They've been told, just hold. You'll be fine long term. And maybe they will, in theory. Person B looks boring. They have a clear asset allocation. They hold a meaningful amount of high-quality bonds or treasuries, maybe some TIPS, maybe a money market fund, not because they hate stocks, because they refuse to design their life around a market mood swing. They rebalance, they keep a buffer, they respect risk. They're building what Graham would call a defensive investor posture. Now the market drops 30%. This is not an extreme fantasy. It happened. It happened in 2008. It happened fast in 2020. It has happened many times in history. Both portfolios are down. But what happens next is where $500,000 becomes either a foundation or a trap. Person A looks at the screen and feels something physical, tight chest, anger, shame, regret. They start doing math in their head. I just lost $150,000. And that's the first mental trap. They think the loss is the event. It's not. The drop is just the market changing the price tag. The real event is what they do next, because now real life enters the room. Maybe they plan to retire in 5 years. Maybe they were counting on that money for a down payment on a house or college costs or helping family. Maybe they don't need it tomorrow, but they need it soon enough that this drop isn't just an abstract chart. It's their life. And because they have no buffer, no margin of safety, no policy, they face the most dangerous question in investing. Should I sell to protect what's left? And here's the cruel paradox. The moment they feel the strongest urge to sell is usually the moment selling is most destructive. Because selling after a 30% drop doesn't just lock in a lower balance. It locks in a smaller future. When you sell shares at depressed prices, you don't just lose money. You lose ownership. You lose the number of shares that would have recovered. That is why the biggest risk in investing is not volatility. It's forced action. Graham didn't build his philosophy around excitement. He built it around survival. And to understand why $500,000 can be not a lot, you have to understand a concept that sounds technical, but is brutally human. Sequence of returns risk. Here's what it means in plain English. It's not just what your average return is, it's the order you experience returns, especially when you're adding money or taking money out. If you're 25, a crash is painful, but often survivable because you're still contributing. You're buying future shares cheaper. Time is on your side. But if you're 45, 55, 60, and you're closer to retirement, or you're already drawing from the portfolio, a crash early in that period can do permanent damage because you're selling into the decline. That's when $500,000 can evaporate like it was never a lot to begin with. Let's do a simple picture. No complex math. Imagine your portfolio drops 30%. It goes from $500,000 to $350,000. Now imagine you also need to pull out money. Maybe not huge, maybe just $25,000 for living expenses, or to cover a gap, or to reduce work hours, or to help with something unexpected. If you withdraw from that $350,000, you're taking out a bigger percentage of a smaller base, and you're often selling the very asset that are down. So you're not just weathering a storm, you're ripping pieces off the roof during the storm. This is why retirement planning and defensive investing are not separate topics. They're the same topic. The middle class doesn't lose money only because markets go down. They lose money because markets go down at the exact moment life demands cash. Now, I want to make something clear before we go further. This is not a fear video. This is a control video, because Graham's message was never be terrified of stocks. His message was be terrified of being forced to act without a plan. That's what a margin of safety protects against. And the modern world makes this mistake easier than ever, because now you don't just own investments. You have a device in your pocket that sells fear in real time. You get push notifications. You get hot takes. You get breaking news. You get influencers yelling about the next 10 times. Your brain doesn't experience investing as ownership. Your brain experiences investing as a threat monitoring system. And that is exactly how Mr. Market wins. So how do you stop panic selling when the market drops 30%? You don't stop it with willpower. You stop it by building a structure that doesn't require willpower. That's Graham. Let's build that structure. Step 1 is the simplest and the most ignored. Separate survival money from ownership money. Most people mix these together. They keep everything in one portfolio and pretend it's all the same. Graham would call that undisciplined, not because it's immoral, because it's dangerous. Survival money is the money you might need regardless of what the market does. Your emergency fund, near-term expenses, major known expenses, the portion of your retirement spending you don't want to gamble on market timing. Ownership money is the money you can truly allow to fluctuate, because you're investing for long-term intrinsic value, not next quarter's price. If you treat all money as ownership money, you'll feel brave in bull markets and trapped in bear markets. If you separate them, you gain something priceless: time. And time is the real margin of safety. Now, in practice, what does that mean? It doesn't mean you hoard cash forever. It means you have a buffer in assets that are designed for stability: high-quality bonds, treasuries, short-term instruments, money markets, things that don't need a heroic market to be useful. This is the boring edge that most people laugh at until they need it. Boring is what keeps you from selling the future to pay for the present. Graham was very clear. For the defensive investor, allocation matters more than cleverness. He suggested that ordinary investors keep a meaningful allocation to bonds, and he talked about ranges, because your allocation should respond to valuation levels and your temperament, not to hype. The exact numbers can vary by person. Some people can tolerate more stocks, some can't. Age matters. Job stability matters. Goals matter. But the principle is stable. If a 30% drop would force you to sell, you're too aggressive for your real life, not for your ego, for your reality. Step 2, decide your allocation range before the panic. This sounds obvious, but almost nobody does it. They say, I'm long-term, but they never define what they'll do when long-term gets uncomfortable. Graham would not respect that. He would call it speculation disguised as optimism. So here's the practical move. Pick an allocation you can defend in writing. For example, you might decide you'll keep something like 50-50 or 60-40 or 70-30 between stocks and high-quality bonds or cash-like assets. Depending on your circumstances, the specific ratio isn't the point. The point is that you choose something that lets you sleep, because the best portfolio is the one you can actually hold. And then you set a simple rebalancing policy, not a complicated one, not a day trading strategy, a policy, something like once or twice a year, or when allocations drift beyond a certain range, you rebalance back to target. Why does this matter? Because rebalancing is the mechanical way to do what Graham wants you to do psychologically. Be greedy when prices are low and cautious when prices are high. Rebalancing turns volatility into a tool instead of a threat. It forces you to sell a little of what got expensive and buy a little of what got cheap without needing to predict bottom. That's value investing behavior applied to an ordinary investor's life. Step 3. Build a panic selling firewall rule that triggers before you sell anything. Here's a rule I want you to imagine like a lock on your front door. When fear hits, you don't decide in the moment. You consult the rule. The rule is this: if markets drop sharply, 20%, 30%, 40%, you do not sell based on headlines. You only take action if one of these is true. Your original reason for owning the asset is invalidated in a fundamental way. You are rebalancing according to your pre-written plan. You need money for survival, and that need should already be covered by your survival bucket. That's it. Notice what's missing. I feel scared. Graham didn't deny fear. He built around it. Step 4. Stop confusing price movement with risk. This is one of Graham's most important teachings. He argued that risk is not measured by volatility alone. Risk is the probability of permanent loss. Volatility is the market offering you emotional tests. Permanent loss is failing them. A stock can be volatile and safe if it's purchased with a margin of safety and supported by financial strength. A stock can be calm and dangerous if it's overpriced and fragile. And a portfolio can look fine on paper, but be high risk if it forces you to sell at the worst time. So when you look at your $500,000, the question isn't, what's the return? The question is, under stress, will this plan force me to behave like a speculator? Because Graham drew a bright line between investing and speculation. Investing is an operation that, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Now apply that to your behavior. If your plan promises safety only if the market cooperates and you never get emotional, it doesn't meet the standard. It's speculative. Step 5. Lower friction, because friction is what turns good returns into mediocre outcomes. This is where ordinary investors quietly bleed. Fees, expense ratios, trading spreads, taxes from unnecessary churn, performance chasing, constant reallocation based on vibes. Graham was wary of anything that encouraged activity for activity's sake. The market already takes enough from you through volatility. Don't donate more through friction. For most investors, a simple, diversified approach, often using broad index funds or ETFs for core exposure, combined with a sensible bond allocation, is a strong defensive baseline. If you do pick individual stocks, Graham's mindset demands a checklist: financial strength, earning stability, a sound balance sheet, and a reasonable valuation. Price versus intrinsic value, not stories. Story stocks are seductive because they feel like certainty, but certainty is usually most expensive right before it collapses. Now, let's return to the heart of the video. Why does $500,000 not feel like a lot for so many people? Because they subconsciously plan to spend it twice. They plan to spend it in good times and still have it in bad times. They plan to enjoy stock-like returns with bond-like stability, and they never built the shock absorbers that make that possible. So when the market drops, They experience $500,000 like sand. It leaks through their fingers because there's no container. Graham would say the container is discipline plus margin of safety. Now let's talk about the mid-video twist. The thing most people miss, even if they understand all of this. The most dangerous moment isn't the crash, it's the recovery. Because panic selling has a second punch. Here's how it usually goes. The market drops 30%. You sell to be safe. You move to cash. You tell yourself you'll buy back when things look better. Then the market rises, often violently, often before headline. Turn positive, and now you face a new emotion, regret. You watch prices go up without you. You feel stupid. You feel left behind. So you buy back, usually at a higher price. So what did you accomplish? You sold low, bought high, paid taxes or spreads, and trained your brain that the market is a trauma machine. That cycle alone can destroy a lifetime of compounding. And that's why $500,000 can be not a lot, because compounding doesn't just require time. It requires staying invested. And staying invested requires a design that your emotions can tolerate. Graham did not demand genius. He demanded soundness. He demanded that you act like a business owner, not a price watcher. So let's build a simple decision test you can use to audit your own plan today. I want you to answer these questions honestly. First, if your portfolio dropped 30% this month, could you go 12 months without selling stocks? Not, would you want to? Could you? If the answer is no, you don't have a volatility problem, you have an allocation problem. Second, do you know what you own and why you own it? In one sentence, if you can't explain it, you're not investing, you're renting someone else's conviction. Third, is your retirement plan based on an assumption that your average return will show up smoothly? Because the market does not deliver returns smoothly. It delivers them with chaos. A defensive plan assumes chaos is normal. Fourth, if you're counting on $500,000 to fund a lifestyle, have you built a spending plan with margin of safety? People talk about the 4% rule like it's a law of physics. It's not. It's a guideline from history with assumptions, market returns, inflation patterns, and most importantly, behavior. A margin of safety approach says, don't run your life at the edge. If you design your withdrawal rate with no buffer, you're forcing yourself into sell at bad prices territory when reality hits. And reality always hits. Now, I promised practical, so let's put this into a simple blueprint you can remember. Here is a Graham-inspired retirement safe framework for the ordinary investor. 1. Build your stability layer. This includes an emergency fund and a portion of your portfolio in high-quality, relatively stable instruments. Think of it as your sleep-at-night layer. 2. Build your ownership layer. Diversified stock exposure, either through broad funds or carefully selected individual stocks. Using a Graham checklist, this is where long-term growth comes from. 3. Set your allocation and your rebalance rule. Write it down. Put it somewhere. Your future panicked self will define it. 4. Create your no headline selling file. You don't sell because of fear. You sell because your written plan says so. 5. Reduce friction. Keep fees low. Avoid constant activity. Treat doing nothing as a skill. This is the core of get rich slowly. Now, I can already hear a skeptical viewer saying, but what if this time is different? What if there's a real crash? What if valuations are crazy? What if AI changes everything? What if rates stay high? What if inflation returns? Here's the answer Graham would respect. Maybe, maybe not. But the defensive investor is not built on prediction. The defensive investor is built on resilience. Your job isn't to be right about the macro. Your job is to avoid being ruined by it. That's why Graham liked balance sheets. That's why he emphasized financial strength. That's why he emphasized paying a sensible price relative to intrinsic value. That's why he emphasized diversification in bonds for ordinary investors. Not because he was timid, because he understood human nature. Now let's bring this back to the U.S. middle-class reality. Most people watching this are not trying to become a hedge fund manager. You're trying to do something that is emotionally simple, but financially profound. You want to stop working one day without being terrified. You want a retirement plan that doesn't collapse the first time the market acts like the market. You want to be able to look at your 401k or your IRA or your Roth IRA and not feel like your future is one headline away from disaster. And here is the hard truth that sounds pessimistic, but is actually liberating. You will never feel safe because of a number alone, not $500,000, not $1 million. You feel safe because of structure, because safety is not a number. Safety is a margin of safety. A person with $300,000 and a strong defensive plan can be safer than a person with $800,000 and a fragile plan that forces panic selling. Because the fragile plan is one bad year away from changing their entire life. Graham would call that an unacceptable risk. Now, I want to close by returning to the opening scene. It's Tuesday night again. You open the app. You see the drop, but now, you don't experience it as an invoice you must pay. You experience it as Mr. Market being Mr. Market. You know your survival money is intact. You know your allocation. You know your rules. And you know something most investors never truly learn. The market can move your prices, but it doesn't have to move your decisions. That's the real freedom. And that's why, in a weird way, the goal isn't to make $500,000 feel like a lot. The goal is to build a plan where $500,000 is enough to behave intelligently. Because when you behave intelligently, compounding gets a chance to do its job, slowly, quietly, without the way Benjamin Graham intended. If you take one thing from this video, let it be this. The market doesn't destroy most people. Their lack of margin of safety does. Build the buffer. Write the rules. Choose an allocation you can hold. Rebalance like a machine. Ignore Mr. Market's moods, and you'll never need $500,000 to feel like a lot in order to be safe. Because you won't be living on the edge of your own emotion. That is the defensive investor's advantage. And in a world addicted to hype, it might be the rarest advantage left.